good, y'all? It's Mala here from the Gym Therapy Pod. And on today's episode, we're gonna do something a little bit different. We're gonna be talking about SVB, AKA Silicon Valley Bank. All right, so let's jump right into it. So this weekend, the bank called SVB, or Silicon Valley Bank, closed. And the reason they closed was because they basically couldn't pay their bills. They didn't have enough money. So we're gonna go back in history and kind of see exactly what happened, like what caused this, like how this is similar to what happened in 2000, 2001 during the internet boom, 2007, 2008 during obviously the housing crisis, and how that kind of correlates to what happened this weekend. So Silicon Valley Bank was founded in 1983, basically in Silicon Valley, with the idea of, hey, let's, invest and let's manage different startup companies. So this bank was like specified or specific to a certain niche. And so a lot of people that were in the VC community, angel investors, VC firms, were using Silicon Valley Bank to get their funding for the investment they wanted to make into like these startup companies, such as, let's say, like a Dropbox or a Uber or a Lyft or Airbnb, you name it. So fast forward, we get into 2023, what was happening was that, well, take it back to 2020 actually. What was happening was that interest rates have been very, very low since the actual, I say, crisis or recession back in 2008. And so what Silicon Valley Bank was doing was they were taking riskier bets from depositors in order to, I'd say, iron out or make more money on top of the deposits that were made from their customers. And because interest rates were so low, they were taking risky bets on like mortgage-backed securities, or MBS for short, which again, you may have heard or have some type of knowledge of from the crisis back in 2007, 2008. And so by the interest rates being low on like these mortgage-backed securities by the government, they're able to collect more money on the back end because the rates are low. And subsequently, a lot of VCs or angel investors are able to borrow a lot more money because the bank now will be able to receive more money on the back end from some of these companies that the firm is lending their money out to and that the VCs are investing into. And so this is risky because you always play the bet that interest rates will rise, which they actually did. I think they hit a high of 5.75, I want to say. Jerome Powell raised it up and incrementally raised it after like the pandemic was over. And so he raised those rates up, and he raised those rates so that he can combat inflation. And how that's bad and how that was bad for the bank was because of those rates getting raised so high, now you owe all that money back on those loans that were lent out. And that led to Silicon Valley Bank not actually having any money or any more money to be able to pay these loans. And so Thursday or Friday, they actually wanted to borrow $2.2 billion because they lost over $80 billion because what happened was this thing called a bank run. And so inside the community, not necessarily in Silicon Valley, but just in general in the VC community or in the angel community, when you see that a bank is like faulting, similar to what happened in 2008, when you see a bank is like faulting, you want to be like, hey, I want to get my money out of here because I don't know what's going to happen. I don't know what's going on. So what happened was the FDIC obviously insured deposits up to $250,000. And a lot of these companies have way more money that's inside Silicon Valley Bank, over $250,000. You have millions and millions and millions and millions of dollars that companies hold there. And so what caused a run on the bank was, hey, we see this imploding. We want to go and get our money out before anything happens, and we will lose the rest of our money. So just imagine if you only, let's say you have $25 million in the bank, you're only going to get $250,000 of that, and then like kind of receive, let's say, a sticker, like an IOU basically for the rest of your money. And we don't know how or when you're going to get that money. But you need this money in order to not only continue to operate, but you need this money to be able to pay your employees. So that's what happened, and that's what's called a run on the bank. So everyone in the community, just everybody who was banking there, went there and was pulling out money. I want to say about 50 billion was pulled out alone in the trading hours on Thursday and Friday, and that's a lot of money. And so what happened was the bank went out and said, hey, we need to borrow money, or we need to have, we need to get bailed out, which again, we saw happen in 2008. Not every bank was bailed out. We saw Lehman Brothers fall. And so there's like, hey, we need to get bailed out. We need some money. And that's what the Federal Reserve will do. They will insure and will be able to print out that money for you. And so if we take it back just a couple of steps, during the pandemic, you saw a lot of SPACs, you saw special acquired companies, you saw a lot of IPOs, you saw a lot of companies going public. And this is because they were getting so much funding because interest rates were so low. So it was just basically cheap to be able to fund these companies and put them onto the market. And subsequently, what SVB had as well was, hey, we'll lend you this money, you invest into this company, we get a percentage of that because we make our money off of these loans and deposits, but we'll also make money off of the back end on the companies that you took public. So I believe Coinbase, when Coinbase went public, SVB was able to buy 400,000 shares for $1. And in the first trading day, Coinbase traded at $328 per share. So just multiply 328 times 400,000, and that's how much money SVB would have made off of that particular investment from whatever VC firm was working with them. So let's fast forward again, and the bank run happened. And so Friday evening, well, not Friday evening, let's say Friday morning during trading hours, the bank stock dropped 60%, plummeted, like just was getting destroyed because everybody was going to take their money out. And so that sends a ripple effect across the community. So now you're wondering like, hey, is my money protected? Is my money safe? And the bank wasn't putting out any statements. And so the only statement they put out was that, you know, obviously everybody who, this is FDIC, so if you had 250, you'll get that. But if you know, all the other uninsured money, we don't know what's going to happen with that money. And so, of course, everyone's like, we don't know what we're going to do with our company. We don't know how we're going to pay our employees Friday or Monday. Like, we need this money to be able to pay our employees. We need this money to continue operating. We need this, we need that. And so that led to a major meltdown in the community because now we're looking at this one bank similar to what happened in 2008 could potentially collapse, not necessarily the banking market, but could collapse a lot of different banks. And you will only have like 4 major players in the banking sector, you know, the JP Morgans, the Morgan Stanleys, the Bank of Americas, and things of that sort. And so what happened during the weekend was, you know, everybody was like, you know, chiming in, like, what can we do? What can happen? How do we fix this problem? How do we assess this problem? How do we solve this problem or the solvency issue? And the only way really for that to happen was for the government to really jump in and say, hey, we're going to make sure that everyone's money that's been deposited into this bank is fully protected and guaranteed. We're going to make sure you have all your money and not just 250,000. But that was delayed for such a long time over the weekend. I mean, it's only 2 to 3 days, but in the span of that, you know, when you're worrying about like your employees and how to pay them, that is like very, very detrimental to a lot of these companies that are invested or that are banking through SVB. Because a lot of companies, a lot of startups are banking through SVB. And so on Saturday, we're still waiting to hear back, you know, hear from like Yellen, hear from Biden about this because, you know, SVB actually went under and the government took over the bank. And so it's like, okay, cool, SVB is gone, like it's not here anymore. So now what? So you fast forward to, let's say, Sunday, and then another bank goes under. And this bank, it's similar to Silvergate. This bank, I cannot think of the name right now, but I'll put it in the description in the caption. But this bank also went under on Sunday as well. And these are 2 of the largest banks in the world. Like, I think one was ranked 16th and then the other was ranked 18th. So they're like top 20 in terms of like banking and have been around for 20, 30 years. This bank went under really because there was a run on that bank as well because they were accepting cryptocurrency deposits. And we all know, what's this, 2023, around 2022, 2021, well, really 2020 and 2021, the crypto space was extremely hot. You had NFTs, you had Bored Ape Yacht Club, was like one of the most popular NFTs. Crypto was just like, Bitcoin was probably trading like 60,000, 70,000. People were like, oh, it can go to 100K. Ethereum. You had all these other coin or stable coins coming out of nowhere. And this bank was receiving deposits from crypto. But last year, or I would say the tail end of 2021 going into last year, crypto just took a major hit. People were pulling all their money out of crypto. You saw, again, I mentioned Silvergate, but this is not the bank I'm referring to, but Silvergate was a crypto-based bank that went under not too long ago because crypto went down so much. Like now Bitcoin is trading on support, I want to say like 20,000, maybe a little bit less. I'm not sure, I haven't looked at it, but they have a major decline. A lot of those coins were just destabilized and just not existing anymore. The whole FTX scandal, even Binance and what they're going through. So that sector has been taking a major hit, but it's it has such exposure, but it had so much upside that people were getting greedy around that time. And so people were getting greedy around that time, and it was like, hey, why not? And that subsequently took this bank down as well. And so we fast forward to Monday, well, Sunday evening going into Monday, Yellen and Biden said, okay, we're going to basically like bail everyone out that is at SVB, and we're going to pay, out all deposits. So if you have more than $250,000 inside the bank, we'll cover it. So you can have 20 million, you can have 5 million, you have 100 million, it doesn't matter, they'll cover it. And that actually saved, which could have been a major collapse, but it did had adverse effects in the market this Monday, because now people were like scared, like, hey, is my money really safe inside of banks, or are they really safe inside of these banks? And so you saw a natural decline in the market today with a lot of banking and banking sectors, because people were scared, like, oh, SVB went under in a day or two. Let me, get my money out. Let me take my money out of some of these banks, excuse me, and diversify, excuse me, where my money is going, where my money is at. And so that's like a high level. We didn't want to kind of go into too much detail, but like kind of like a high level of what happened this weekend with that banking system. One of the biggest things, in my opinion, that is a flaw is greed. When you understand these instruments and see how you're making money on the back end, on the front end, and you see the money coming in, there's always a time in the market. It's been unprecedented. I think we've been in a 14-year bear market. I want to say it's been a bull market. And so now it's bearish. And so now things aren't like, the market isn't like just a natural uptick. Like things are sideways, things are going on the decline. Interest rates are going higher because inflation has gone higher. We need to stable that. And so now that greed that kicked in before is subsequently being, like kicked out, because the interest rates are rising, inflation is rising. We need to stable that. But at the same time, these MBSs, or mortgage-backed securities that banks are invested in, they were investing that money, or depositors' money, into that with the idea or notion that interest rates will never rise, or interest rates will stay at zero, which is impossible. History, if you look at history, you see, again, this happened in 2007, 2008. Even before then, you saw the rates rising. It just didn't happen or hit until 2008, 2001, when everyone was investing, or all these the dot-com bubble. So you had like AOL, we had Yahoo was public, Google was just coming out, obviously Apple, Microsoft, like you name it, any company that had a .com next to it will receive funding. Like, okay, if I made a company with .com, you get $5 million. Doesn't matter, right? And so we have saw these trends, we have saw these things happen over and over again. And the biggest problem with that is that natural greed that comes about from doing this. And so I'll leave with this. When you're investing, or when you are managing your money, you want to make sure, one of the things that you can do is diversify where your money is at. I think it was a story that came out this week as well with Giannis, and how he has his money, in like 50 different bank accounts, which I don't necessarily agree with, but the reason that he does it is because every bank account that he has his money in is insured up to $250,000 with the FDIC, which means that if something happens, he'll get, that $250 back, so he doesn't keep more than $250 in those accounts. I understand the strategy with it, but there are other ways to make sure that you are protected if something like an SVB was to happen, because again, no one suspects that a bank will fall, especially a bank that's been around for 30 years and has a ton of credibility, especially in that space. But diversify like your palette, diversify where your money is at, diversify your investments, not only obviously in the market when you're investing into stocks, bonds, ETFs, things of that sort, but things like real estate, just in business. And when you're investing your money, make sure that it's diverse, make sure that it's spread out, because you will be protected. That's a way to protect yourself from just having all of your money tied up in one entity, because if this bank was not bailed out, a lot of people would have lost a lot of money, and it just would have caused a downturn. All right, I know it was a lot of information, but I felt that it needed to be talked about. And I wanted to try something a little bit different, talk about different current events or things that's going on in the market in real time. So just let me know how you guys feel about that, and if you want to see more of that. As always, we're dropping content every single day, every single week. So please, please, please make sure that you like, comment, subscribe, and share. Tell a friend to tell a friend. And again, I'll see y'all next week on another episode of Tactical Tuesday.